welcome to this week's update. And today we'll be talking about the LIRP, or Life Insurance Retirement Plan. More specifically, we're going to be talking about creating a laundry list of things to look for when shopping out the right LIRP. Before we get started, let's introduce our speakers. That would be good. First, Brian Walker, president of the AFI Group, financial advisor, entrepreneur, and father of two. Brian, welcome to this week's broadcast.
Thank you, Robert.
Pleasure to be
here. No smoking.
What?
And I'm hearing the voice of our other speaker. Welcome, Edward Shu, founder of Financial Inception Services. He is a Marine Corps engineer turned financial advisor. Edward, thank you for joining us today.
Thank you, Robert, and thank you for remembering that I was in the Marine Corps and not the Coast Guard.
Well, thank you for not insulting the Army, of which apparently one step below the Marine Corps. I won't tell that to all my Army veterans, though. So, as we get started, Brian, really quickly, can you help us summarize some of the benefits of the LIRP, or Life Insurance Retirement Plan?
Well, first, real quickly, explain to me why are you in my skybox? What's going on there? I don't remember the invoice trading hands.
Well, my house is being remodeled, so I got kicked out, and so yes, I grabbed my sleeping bag and a case of beer, and I am hanging out in the skybox. So thank you very much.
Nice. Well, make sure you clean up after yourself, okay? All right. Now, let's talk about LIRPs and the tax-free bucket. Now, what is an LIRP? Why is an LIRP a great piece to have in anyone's portfolio? Well, first and foremost, you can use it as a retirement plan, just like your IRAs and 401ks, but it has a lot of benefits that those types of accounts don't offer you. First and foremost, distributions pre-59.5. If you have an IRA or a 401k and you need access to that money pre-59.5, you will be hit with a 10% penalty. Not the case with the LIRP. Second, all of your growth is tax-free, right? The LIRP belongs in the tax-free bucket because the growth is tax-free, and also the distributions are tax-free. So the distributions are not reportable income. The IRS doesn't even know you're getting those distributions. Also, there are no income limitations on the LIRP. So if you want to contribute to a Roth IRA, that is a true tax-free account, well, if you make too much money, you can't even contribute to a Roth IRA. So there are some limitations there that don't apply to the LIRP, and also contribution limits. So we have clients that contribute $50 a month, up to $300,000 a year into their LIRPs. And some of you are very aware that you cannot contribute $300,000 into your IRA or your 401k. So those accounts do have some limits. And lastly, there is no legislative risk. So what do I mean by that? Well, the LIRPs are a contract between you and the company that offers that LIRP. So any of the laws that are in effect when you open up your LIRP, those laws will be there as long as you have the LIRP, no matter what changes in the laws. So the laws have changed 3 times in the history of LIRP, 1982, 84, and 88. And if you had an LIRP prior to that, you were protected by a thing called the grandfather clause. So all the rules after those law changes applied as long as you had your LIRP.
And sounds like a lot of amazing benefits. And from the first impression, I think a lot of people would say it almost seems too good to be true. Why wouldn't I transfer more of my assets into an investment like this? So Edward, maybe you can help answer that question.
Yeah, definitely, Robert. And that's the thing is, you know, the way Brian describes it, it sounds like the holy grail of investments in the tax-free bucket. And I'll agree with him, there are a lot of great benefits, but there are very distinct differences between an LIRP and say like a Roth IRA. So one thing we know is unless it's Easter, it's not great to have all of our eggs in one basket. And if we talk about a couple of the differences, LIRPs may have some limited growth, but they also have safety guarantees on the downside. Whereas a Roth, we have the potential to have higher earnings along the way as well. So I don't want to say that it doesn't have amazing benefits. It does. It has a lot of them. But what we need to do is we need to ensure that we very strategically determine how much we want to utilize for LIRP, how much we want to utilize for Roth conversions. For some people, there's even an ideal amount to maintain in an IRA or a 401k because we could, create a tax-free stream of income with that. So yeah, a lot of benefits, but we don't want to put everything in there. We want to do it very, very strategically.
Yeah, fantastic. And talking about doing it strategically, Brian, if you had a strategy to recommend when shopping out an LIRP, can you give us some bullet points of some things that people should be looking out for?
All right. So the first thing you want to look for is safe and productive growth. You want to make sure that the LIRP is going to help you grow your retirement nest egg in a safe way, and you have some protections against that as well. Number two, low fees. You want to make sure that you're not giving away money in the form of fees because you're going to lose opportunity cost by doing that. So if designed correctly, those fees can be low. You also want to make sure that your distributions are tax-free and also cost-free. So there are a variety of ways that you can receive your income or distributions from your LIRPs. So look into those fees or costs very carefully. And lastly, you want to make sure that there is a free long-term care rider. So a lot of companies will offer long-term care, but it will cost you, and it'll be just like buying a long-term care policy. But there are providers that have cost-free long-term care options. So look for that.
Fantastic. And Ed, if you could help us better understand too, once we find or narrow down the list for the right type of LIRP, what are accumulation strategies exist or that are available within these plans?
Yeah, definitely. And what you want to look for is kind of one of the first things that Brian mentioned is safe and productive. And usually a lot of times safe and productive means low returns. Well, what you do is you have three main options within an LIRP. You have one, which is essentially allowing your funds to be invested the way the insurance company wants to invest them. I like to call this the fixed rate. And what they're going to do is they're going to give you a certain percentage rate that your money is going to grow year over year. Now that's generally very conservative and it's dependent upon interest rates. And since interest rates are fairly low right now, that rate might only be around 3% or 4%. In some cases lower, in some cases higher. You can also allow those investments to pass through to a mutual fund type investment called a sub-account. But the problem with that is you're basically not getting all of the safety and potential guarantees associated with the LIRP, because in those sub-accounts, those values can grow with the market, so you can get substantially higher returns, but you can also lose money, and that's what we're trying to avoid with the LIRP. That brings me to the third option, which is generally one of our favorites, and that's called an indexed account. The indexed account will track exactly that, an index that we know. One of the most common is the S&P 500. Now, when I say it tracks it to a degree, and it's what I like to call a collared return. And the reason I call it a collared return is that it guarantees that we can't lose money as a result of market fluctuations. But what they do is they put a cap on our gains. So while we may have anywhere from 0 to 1% as a minimum guarantee, the top end may be as high as 11, 12, or 13%. So to put that in perspective, the S&P over the given year is down 20%. We either get 0 or in some cases credited 1%, depending on the carrier. On the top end, if it's up 20%, we're going to get credited a capped amount of that 11 to 13%, again, dependent on the carrier. And what we found is by using that type of return over the long term, say like a 20 to 30 year period, we have in excess of a 93 to 95% chance of earning somewhere between 6 to 9%, all without any real downside risk.
Right, Ed, appreciate it. And to be fair, all of the options, accumulation options that you just listed, have some or all of the essential shopping list items that Brian recommended earlier. But Brian, of the 3 options, is there one that stands out more appealing than the rest to you as an advisor?
Yeah, the index strategy seems to be the more well-rounded. It gives you downside protection, which is great any point during your accumulation. It also gives you the potential to have market-like returns. So it kind of gives you a little bit of both, but not too far in either direction. So it makes it easy to plan around.
Yeah, absolutely. And both of you teach a more comprehensive workshop on taxes and retirement that goes deeper into kind of the overall plan and how the LIRP fits into the strategy, because really it's just a piece of the puzzle, as Edward alluded to, Roth conversions and some other options. So in regards to the overall plan and fitting this in, if you would like to watch their webinar, Taxes and Retirement, you can go to the link below in the notes. Also, feel free to follow us on Facebook or subscribe to the channel and be notified of any future upcoming educational videos that are being created so that you can take control of your retirement income planning. Thank you guys for joining us this week, and we'll look forward to seeing you again next week.
Thanks, Robert.
Thank you.